Hello, everyone. I hope you're enjoying this lovely Friday evening. This is Marie from MarketsFlow. It's the 20th of September, and we are recording this 2 hours before the close on Friday as we bring you this weekly performance for the week ending September 20th, 2019. How are you today, Adam?
I'm fine, thanks, Marie. A short holiday last week, which was very pleasant, and even back here in London, there's a bit of summer feel still in the air, so all is well, I'd say.
That sounds lovely. Hope you had a great time. So let's get started. This is Webcast 21 for MarketsFlow's portfolio performance for week ending September 20th. Our podcast is recorded every Friday and is uploaded immediately on YouTube. Please subscribe to our channel so that you can receive it as soon as it's available. MarketsFlow is an FCA authorized robo-advisor and digital wealth manager. We are also SEC authorized. Your deposits are protected by the FSCS for up to £85,000. Before we start, I would like to run through our disclosure. Your capital is at risk, and any financial performance figures refer to the past, and that past is not a reliable indicator for the future. With that said, let's cover the important subject of how did the portfolios do, Adam?
Well, up to now, and as you mentioned, we're not all the way through Friday yet, but we're most of the way through Friday as we speak. The situation is as follows. High growth is at 0.31% this week, and that, looking a little further back, means that it's up 5.7% since the launch of accessible portfolios at the start of June. For the growth portfolio, the figures are up 0.25% for this week and 5.59% since that earlier launch date. And for the ISA portfolio, 0.24 and 3.46 being the returns this week and the returns since launch.
And how has the market as a whole performed this week?
Well, at about 1 o'clock Eastern time, since we're talking about US equities, the market was at a level almost exactly equal, within a point, I think, of last week's close. Having spent the week up until that point continuing its move towards becoming more calm and more stable on the surface, and even some of that calm extended to a lot of the components inside the market too, which is something we've spoken about before. The moves at aggregate became even smaller than the week before. But since then, we've seen a rather quick drop, a sell-off. It was modest size, but very quick. It's just in the last hour or two, with the S&P rapidly down 0.5%. I mean, it's recovered quite a bit of that since. And as we sit here, it's only down about 0.35%. Relative to the end of last week. So that's negative 0.35. But what's been quite significant is the speed of that move. It's being attributed in the news to a blip in the trade talks where there's been a cancellation of a Chinese visit to the US Farm Belt, supposedly in response to some remarks made by Trump, which is par for the course with Trump, I suppose. Whether this is a case of fishing to find a convenient story to match a price move that was needed to happen anyway, but it seems plausible. But this brings us to the next point: volatility. There'd hardly been any volatility worth mentioning in the market on aggregate, and so therefore, no, that carries through to implied volatility as well, which attempts to capture expected volatility. That's been dragged down by actual volatility. We'll come back to that in a moment. But suffice to say that we spent most of the week between 13 and 14. And back in those two brief periods in August where there was a considerable amount of market distress, we were in the low 20s. So that's how much volatility has retreated. But of course, with the last hour or two, that's changed a bit. We shot up to a number between 15 and 16, and then I think it started to dissipate a little. But this is all in the last 90 minutes or so.
Okay, and so what about the allocation within the portfolios?
Well, we have been more heavily allocated this week than in some recent weeks. I'd say at times we'd had more than 50% of the capital deployed, but we've also been quite quick moving in and out on certain holdings, and really this week has been about stock rather than options. Option premium has been too low for us to sell any, in view of the fact that there are still various catalysts that could cause jumps or spikes in market prices, and we didn't feel sufficiently compensated for that. But although we're not quite all the way through today's market yet, based on where we are now, having generated approximately 0.25% or so on each portfolio in a market that's down by about 0.35 as of the latest numbers we've seen, I think it's been a reasonably good week.
How would you characterize the opportunities to make money in this week's market?
Oh, that's a good question, and it's one that does vary from week to week. Well, certainly having a buy and hold strategy on the market, the aggregate market, which I suppose you could call passive investing, would have given you nothing this week, and then in the closing hours, I guess a little drop at the end of the week. And there also wasn't much opportunity for market timing because the aggregate market up until just now was fluctuating just a very small amount within a very tight range. So not a lot to go at with that. Stock selection, yes, I suppose was more fruitful fishing there because there's still reasonable dispersion between the behavior of different stocks. But then again, often the trends at the stock level prove to be a little bit short-lived. Or you could say there weren't many individual stocks from the universe that we're selecting from that started to move a certain way and then proceeded to carry on moving that way. There'd be reversals or things would run out of steam. So perhaps the opportunity was in a combination of some stock selection, but doing it over very brief holding periods. Just buy and sell after you've satisfied a little bit of return. Don't be too demanding or wait around for a large return, otherwise it would be too late and the risk of reversal is too much.
And what do we look forward to from here over the next week or two, Adam?
Well, I always worry when we talk about this that I sound repetitive, but I'd say there are plenty of stories around within a geopolitics space that are evolving day to day, and these have got the potential to move markets if markets are in a mood to be moved. There's still plenty of time to dwell on these before the next earnings announcement season gets underway, which isn't until October. Of course, one debate taking center stage, of course, and now that we're on the way to lower rates, is what more will the Fed be doing from here, and how effective will it be in its impact on markets, besides its impact on anything else? Whether there's too much past tightening still stored up, waiting to take effect with a lag before any of the benefits of this loosening start to come through. That's the debate that I've heard a bit of. We've gone from a few quarters ago, economies in good shape and tighter policy, to economies running out of steam somewhat, but central banks starting to be supportive. So what's the net effect of those forces pushing against each other? Interesting stuff, and eventually we'll see how that plays out. But in terms of trying to manage portfolios from that day to day, these aren't necessarily very useful things to be focusing on. These are longer term phenomena. But what I think is of much more immediate interest is what we've seen of market behavior in recent times, and then this little scuffle that's broken out, shall we say, the closing hours of today. A gently grinding higher, stabilizing market with shrinking volatility for a few weeks now, and then it had almost become too quiet to be true, and then suddenly a little leg down. This happens sometimes, when a path is too much one way for too long, too consistently. The longer it goes on, the more likely it becomes that something's going to change. But depending how investors are positioned, what other catalysts are coming along at the time, what it might lead to is a different question. So this may prove to be a temporary disturbance, but so I'd be very interested as we enter next week on how far this sell-off that we've seen in the closing stages of today, occurring after all the European markets had already closed, how far this propagates in the US and in other markets. That's probably of the most immediate interest.
Thank you, Adam. So that brings us to the end of our podcast. Thanks for watching or listening to us on YouTube. Please remember to subscribe to our channel. Have a great weekend, and we look forward to our next Friday's podcast. Take care.